Hi, this is Michael Jones, Chairman and CEO of Caravel Concepts. Welcome to Market Insights, our commentary on economic and market events. Let's get started. We have to start this week's Market Insights by extending our heartfelt thoughts and prayers to the people of Louisiana for the natural disaster that they have once again had to endure, and to the people of Afghanistan for the man-made disaster that they are also enduring. All our thoughts and prayers go to both of those long-suffering peoples. Now, transitioning very abruptly to what has been surprisingly good news on the market front. The market continues to push to brand new highs and seems to be ignoring any implications of Delta, COVID, and some signs that Delta is starting to have some real implications for the economic growth recovery that we were all counting on. Now, one of the reasons why, in our opinion, that the markets have been able to pretty much so ignore the short-term headlines is because we have seen continued support from the Federal Reserve for asset prices. The Federal Reserve has continued its policy of printing $120 billion every month and then injecting that $120 billion into financial markets. They're starting to hint that in a few months they may print only 80 billion or 60 billion, but they also made it very, very clear that they have absolutely no intention of running the money printing machine in the opposite direction and pulling money out of financial markets for a very, very long time. And markets have taken a great deal of comfort from that. And the implications of that money printing were made very, very clear this week, not just in the new highs on the NASDAQ, not just in the new highs on the S&P 500, but also in a 19% year-over-year increase in home prices that was reported by the Case-Shiller Index. 19% increase in home prices in the midst of a global pandemic and a recession. It's absolutely extraordinary. And there's really only one explanation for it. It is the fact that the Federal Reserve has printed a huge amount of money, shoved it into financial markets, and driven mortgage rates down to all-time lows. As a matter of fact, for month by month, for the last 18 months, home price appreciation has been running far ahead of anything that we saw in the housing bubble of the early 2000s. And people are starting to talk about a new housing bubble and a crash in housing markets. We need to fasten our chin straps and expect another 2008. And we probably need to take a second to say what this 19% unbelievable rally in home prices means and what it doesn't. All right, first of all, let's be very clear in what is different between this housing boom and the 2000s. In the 2000s, home prices weren't going up because more people were getting into those peak home buying years and they could afford a new home and an upgraded home, blah, blah, blah. The boom of the 2000s was based entirely on new gimmicky mortgages, subprime mortgages, where they were extending mortgage loans to people who normally wouldn't qualify for that level of debt. Interest-only loans, where they couldn't really afford the size house that they were buying, but they were hoping that their incomes would grow fast enough that by the time this interest-only loan converted into a full payment, that somehow their pay would go up enough so that they would be able to make the much, much higher payment. These were just two of the many, many, many types of gimmicky mortgages that were introduced in the late 90s and the early 2000s. And this new gimmicky mortgages, extending loans to people who might not be able to afford them, extending loans and allowing people to buy homes that they actually didn't qualify for the fully amortizing mortgage payment. that drove home prices up. That fueled a huge boom in home construction. We were building more than 2 million homes a year at that point in time. And the whole house of cards came collapsing down when 2008 came, the global financial crisis, and it became clear that incomes weren't going to be rising fast enough. And all those people you lent to in the subprime arena, they weren't going to pay those loans back. And there was a cascade of defaults on mortgages. There were liquidations of homes. Home prices collapsed across the globe, which made more mortgage defaults occur, and it became this downward feeding cycle. All right, fast forward to 2021. This housing boom is completely different. It has been built on two much more solid foundations. The first and most important is demographic. The millennials are hitting their peak home buying years. They are getting into those late 20s, the early 30s. They want a home. They're having kids. They need the space. And they're moving to the suburbs just like their parents did for the exact same reasons. A yard and good schools for the kids. And so that has driven this housing boom, fundamental, solid demand from the millennials. And let's remember that the millennials are the biggest demographic group in U.S. history. They're even bigger than the baby boom. All right. Second fundamental underneath this is the Federal Reserve has been buying trillions of dollars of bonds and driving up bond prices and driving down interest rates. Mortgage rates are at all-time historic lows. The kind of lows that if you had told me back when I was a mortgage portfolio manager that we would be having 30-year fixed rate loans at 2.5%, 2.6%, I would have laughed. There was no way that's possible. Well, guess what? It's possible, and that's happening right now. And those low mortgage rates are allowing people to afford a home, not with a gimmicky mortgage that's going to reset into a higher payment at some point, but with a 30-year fixed where the payment will never, ever change. And these people are being qualified for these loans using pretty conservative underwriting standards because it's been recently enough that we went through the disaster of 2008 that a lot of the people that lived through that disaster are still around and are not letting the same kind of aggressive underwriting mistakes happen. So this mortgage boom has been built on much more solid foundation. Does that mean that it's good to go and home prices are going to keep going up at 19%, or maybe they'll slow to 10%? We don't think so, because inevitably one of those fundamental pillars is going to come down, and that is the low interest rate. And we believe that because the Federal Reserve is saying they're going to slow down their purchases of bonds. And they are going to, at some point in next year, probably stop purchasing bonds altogether. Now, the problem with that is that the U.S. government, the largest issuer of bonds, is going to be running about a $2 trillion deficit. And they're going to lose a $1.2 trillion buyer of bonds in the Federal Reserve. Same amount of bonds hitting the market, less buying from the Federal Reserve, that will probably put upward pressure on interest rates, which means mortgage rates are going to be rising in our estimation at some point in the next 12 to 18 months. That's going to be a problem for, home prices, because they've risen to the level that they have simply because low rates have allowed people to buy at a higher price because the interest rates are so low. Take away the low interest rates, you can no longer afford that higher price. Does that mean we see the catastrophic collapse of 2008? No, because the people who own their current houses, they've got that 30-year fixed rate loan. It's never going to change. They could afford it last year, they can afford it this year, they can afford it next year, even easier. And so what that means is you're not going to have the cascading defaults. You're just going to have a hard time for new buyers to pay these inflated prices. And that probably means that prices stagnate, maybe they come down a bit, and we could see a very long period where home prices don't go anywhere. Because if you look back over the last 18 months since COVID hit, the Fed hit the printing presses, the interest rates fell, we pretty much so baked in the next 5-10 years of home prices appreciation into the last 18 months, and that will ultimately catch up with us. Thanks for joining us for Market Insights. We hope you found it informative. If we did, we hope you can like the video and share it with your friends. Also, if you want more of our research, you can find it at our website, caravelconcepts.com. Thanks.
That was impressive. Your ability to zone out this monster.
Nah, he was just...